Mutual Real Estate and the 2022 NAB Wisconsin Board President. I'm proud to be with you today as your MC for this afternoon's 18th Annual Market Update. NAB Wisconsin and the Commercial Association of Realtors Wisconsin are pleased to work jointly to bring this much anticipated event to you. And of course, we're so glad that this year we could be in person. Our speakers have done an incredible job of preparing for tonight, and have each have a lot of informative data that they'll be sharing, as well as some very interesting insights about the events in the market driving the data. As they are presenting, please note, much of the information regarding the submarkets, boundaries, and definitions are covered in the program on the book that you'll find on your table. We hope you will refer to this throughout the program, and will also recognize our full speaker bios and sponsors who are featured in that book as well. You will also find a few placemats, the larger pieces of paper at the table, outlining some of the highlights for each of the markets. The placemat and presentations will also be shared with all of you electronically following the event. Finally, if you find yourself on your phone checking Twitter or Instagram during any of the presentations, the least we could ask is you could give us a shout out, and also please hashtag Market Update 2021. We could not hold this fantastic event without our many sponsors. Now we're going to hear from our presenting sponsor, First American Bank. Please join me in welcoming to the stage First American Bank's Pam Turr.
Welcome everybody, it's so great to see you. I'm going to emphasize Liza's comments and let you know how happy we are that everyone is here in person today. On behalf of First American Bank, I'd like to welcome you to the 2021 Market Update. We're so pleased to be a sponsor again. First American Bank is about almost 50-year-old privately held community bank. We have a full suite of commercial business products and commercial real estate products. I know we've worked with a lot of you in this room. If we haven't had the pleasure of talking with you or you want to know more, please stop in and check with one of our wonderful professional bankers. I guess I'm looking forward to this presentation. I'm looking forward to the experts, and I'm wondering what everybody's going to say about all of the asset classes this year. I know Mark Ergens is not here this year, so I guess the office speaker is going to have to find somebody else to suck up to this year. But there are other Ergens people in the room, so you've got them, and you've got Jason Luther at our table, who's also an office developer, medical office developer. Thanks again. Have a great 2021 holiday season, and I'm looking forward to a happy and prosperous 2022. Thanks, everyone. Thanks, Pam. And now on to our other sponsors who support and make this event possible. First, our networking sponsor, Reinhardt Berner Van Duren Attorneys at Law. Our silver sponsors, Korb and Associate Architects and Wisconsin Group. A special thank you to our data sponsor, Catalyst, and our sign sponsor, Innovative Signs. We also owe a special thanks to Nate Winkle with NEWMARK for his extra time and effort in putting data together, clarifying questions, and working with our association staff. And now we're going to dive into the presentations. We have a lot to cover today, and this is a rare opportunity to hear from 4 industry experts that we're grateful to have with us. There are exciting things happening in the market, and they're here to share stories behind the data, so let's get started. Our first presenter is in the office market. Please welcome from Founders 3 Real Estate Services, John Davis.
Good afternoon, everyone. It is a true pleasure to be here with all of you tonight to talk about COVID-19. I'm kidding, but I will do my best not to mention it more than 200 times in my 12-minute speech, so you're welcome. In fact, why don't we make this a game? Every time you hear me mention COVID or the pandemic, please feel free to take a drink. What a year it has been. The roller coaster of emotions from the continuing shutdown in the beginning of the year to the 4th of July opening, then Labor Day, and now the beginning of 22. We know much more now than we did even 6 months ago, and we are way more prepared in dealing with COVID and how to get back to normal, which has a direct correlation to my main topic tonight, the 2021 office market update. The overall vacancy in 21 has risen 1.8% from 2020, reaching a rate of 18.5%. For reference, looking back to pre-pandemic, 2019's overall vacancy rate was 14.9%, so there's no doubt that the office market took a hit. It's important to note that the BMO Tower, the Michaels Building, and others were delivered in 2019, since 2019, so COVID may not have had much of an impact in Milwaukee that some had predicted. I'm going to breeze through these next slides so no one falls asleep on me, but for the analytical folks in the room, I can email these charts. I found one of the most interesting data points is the downtown vacancy rate, which has risen by about 1% since 2019. Although we did see a slight increase in vacancy rate, the idea that companies downtown would revert and run to the suburbs just did not get legs. In fact, downtown activity has only gotten stronger as the year progressed, especially in the downtown west submarket, which I will dive deeper later in the slides. The average deal size in 2021 was about 5,000 square feet, and the average term is about 4 years, which shows a continuation of shorter-term deals from last year, as many companies still want flexibility. Although there have been long-term deals, most of them come with early termination rates. Since March of 2020, there have been numerous short-term deals in response to COVID, and many companies that punted will be rolling over in 2022. Class A and B average gross asking rates are $29.81 and $21.21 per square foot respectively, which is a slight increase from 2020. Demand has increased in 21 from 2020. There's no question about that. Some key factors in this rise in demand are the following. We now have a vaccine and booster shots widely available. We now have a better understanding of COVID and how to deal with it. And employers want to get their employees back in the office. The majority of users in the market are independent, smaller users right now, but we will see major corporations begin to bring back employees in early 22. Once that happens, the smaller companies that are still uncertain will follow by example, which will help us get back to somewhat of a normal level of leasing activity. The main takeaway from this is that demand will increase in 2022 when corporations bring employees back to the office. I will dive deeper into the other trends shown later into the presentation. There were some notable deals this year that have broke up between the suburbs and downtown. In the past, renewals maybe weren't as notable. However, it is important to note the renewals as it shows companies still recognize the importance of an office space. The suburban market outlook. The suburbs have been somewhat resilient with increased activity as 21 progressed. The North Shore and West Dallas submarkets experienced positive absorption, decreasing vacancy by 0.6%. An important note is that the Lydell Center office building, consisting of 253,000 square feet, was removed from the North Shore office set, as it is being converted to industrial. This is still a positive sign showing the North Shore retained tenants during COVID. Brookfield experienced a slight uptick in vacancy. However, this submarket will perform well looking into next year. Pewaukee and Brookfield had some significant size renewals, which I showed on the previous slides. Quality, well-maintained properties in the suburbs will continue to succeed into 2022, especially properties along I-94, which have been very active this year. Ergens clearly is also confident in the suburban office market with the announcement of 2 new office buildings at the Innovation Campus and 1 new building located at the corridor. Ergens developments are typically an indicator of strong markets, so that was very exciting news for the suburbs. Cobalt Development also recently announced plans for what could be up to 300,000 square feet of office space in the North Shore. The downtown market. The flight to the suburbs from downtown that a lot of people thought would happen this past year did not happen, which is music to downtown landlords' ears. This may have taken place in other very large, dense cities, but we luckily did not experience that. Downtown East completed deals remained somewhat flat this year. However, tenant activity has increased in the 3rd and 4th quarters, which should translate to more completed deals in 22. A particular trend to note that we are seeing is what is being dubbed as the flight to quality, which means tenants are looking to improve the quality of their office space and building in order to attract and retain employees. In many cases, tenants are shrinking their footprint by hoteling employees and are able to now afford an upgrade in their space. Downtown West in particular has been extremely active in 21. The Avenue development has proven to be the major catalyst for the Westtown boom in activity with their amenity-rich building that includes a brand new food hall. Following the Good Karma and Herzing deal, the Avenue is now approaching full occupancy. If you haven't been to the Avenue recently, I would highly recommend checking it out. In fact, the 3rd Street Market Food Hall will be opening very soon, so definitely stop by. Hub 640 and the ASQ Center will see an increase in leasing activity next year, as more and more people's opinions about office space west of the river are changing. Announcements such as Milwaukee Tool, the Convention Center, 3rd Street Market Hall, and the Milwaukee Symphony Orchestra will help further grow this market for the foreseeable future. Despite this whirlwind of a year, there were still some major headlines in the office world. Milwaukee Tool commits to downtown and purchased 501 West Michigan Street. Generac purchased American Family Offices in Pewaukee. Johnson Controlled sold their downtown office and will move to Glendale, which is a big hit for the downtown. We will see how that works long term for them, or if they will come back downtown. Either way, Bear Development will do something very cool with the property. Milwaukee Public Museum announces they're moving near the Deer District. The Deer District broke ground on the Trade Milwaukee, which is a boutique 205-room hotel. I mention this because I believe future development in the district will continue into 22. And finally, 330 Kilbourne and just recently Chase Tower sold the group RMC. Office market hurdles. The office market took a hit from the pandemic, and that continued into 21. The perfect storm of rapidly increasing construction prices, labor, and supply issues all seem to hit at once, which has made completing deals much harder than before. Specifically, lead time on building materials and a lack of workers to build out spaces has proven difficult. For example, I recently got a lead time for something as simple as office doors, which we learned are at least 3 months out. Furniture has an even longer lead time in some cases. Due to these lead times, I want to point out an important trend to note. That trend is the demand for spec suites. Many groups that were uncertain and kicked the can down the road are scrambling to get a new office space, and due to the lead time for materials, they cannot wait for a build-out. We are seeing a heavy increase in tenants seeking spec suites, and will continue to see this trend into next year. In addition to those issues, there are many options for tenants to choose from, and rents still have not increased, which makes deals even harder to complete for the landlord. With rising prices across the country on everything, rental rates should increase into 22. Another wrench thrown into the mix is the increase in subleases that peaked into 21, in mid-21. We aren't seeing many new subleases hit the market recently, but there are some significant size subleases still available, such as Manpower and Corals and Brady. Corona, I just threw that out there for the thirsty folks in the room.
Double down.
Some new decision-making factors. Bringing people back to the office is a priority for the majority of employers. The question is how employers are accomplishing it. The answer is upgrading the quality of their space. The flight to quality has been a theme in 21 and will continue for the foreseeable future. Many companies are shrinking their footprints but upgrading their office space with amenity-rich properties that help to entice employees to want to be back into the office, as well as an advantage for their hiring, retention, and recruitment of employees. Collaboration space and upgraded tech equipment within the office are the most important aspects tenants are seeking for new space. Companies still strive to instill their corporate culture to create team camaraderie, and the best way to do that is human interaction. Being in the office and collaborating is key for corporate culture and the success and growth for most companies. Another interesting factor will be parking. An employee would argue, why pay $200 a month to park downtown when I can work from home and avoid that cost? Although many companies already pay for employees to park, I think companies paying for all employees parking will become the standard from now on. Interstate has already developed a flex parking schedule which will help companies that are trying the hoteling model. Another factor will be the ability to bring dogs to work. I know that sounds crazy, but during the pandemic, many people have gotten used to staying home with their dog, and pet-friendly work environments is what employees want, and we are seeing some companies and landlords taking note and changing policies. At the end of the day, employers want to replicate the comforts of the home office with their office space to attract employees back. As most of us know, there are many options of office space for tenants to choose from. I did a search for 3,000 to 4,000 square feet and came up with 46 options in the downtown east and west market. That being said, rents have not dropped, and as I mentioned before, I believe rents will increase in 2022 due to the rising costs across the board. Deals from the landlord's perspective have been skinnier this year due to the cost of construction, but you will see those rents increase specifically for quality buildings. Buildings without many amenities will struggle due to competition. However, and I know I sound like a broken record on this, but landlords that have invested in providing amenity-rich and well-maintained buildings will succeed in 2022 as major corporations begin to return to the office and seek new space. Many of the smaller and still uncertain companies will play follow the leader after that happens. The 4 takeaways I want to leave you with are the following. The office market will make a big comeback next year and reach pre-pandemic levels by 2023. Spec suites will continue to be a trend into 2022. Going back to the flight to quality theme, amenity-rich, well-maintained properties are what employers will continue to seek, as those buildings are the type of properties employees desire to work in. The winners in the market will be landlords that are upgrading and adding amenities to their properties now, instead of waiting for deals to come. Sorry, Ben. So Ben Anderson's predictions, how did he do? Ben predicted office isn't dead, which I am happy to report he was right. Although the office market took a hit these last 18 months, 2022 will be a year where we see the market reset. And by 23, I hope we're all saying, what pandemic? Ben predicted a vaccine will become readily available by December of 21, leaving the companies returning at full capacity. The vaccine rolled out in the spring of 2021, however, once the Delta variant hit, the uncertainty and surge in cases delayed the return to office multiple times throughout the year. Ben also predicted demand for office space will increase significantly in Q3 and Q4 of 2021. I would agree it has increased, but not significantly, and again, that's only due to Delta. The best prediction of all was Ben predicted Giannis will lead the Bucks to the NBA Finals, which they did, and then went on to win it all. Good prediction, Ben, and Bucks in 6. Now, on to my 22 predictions, which I don't know about you, but I'm feeling 22. The flight to quality will continue with downsizing of space, but upgrading the quality of the office space to bring workers back. At least one single-story office property in Park Place will be converted to an industrial use. The Deer District will be the next highly sought-after area in the market. A large out-of-state company will open a downtown Milwaukee office. And finally, the Packers will win the Super Bowl in February. Rodgers will finally cut his hair and then get immunized once again before next season, where he will remain the Packers starting quarterback. I want to thank Elizabeth, Jenna, Kevin, and Ned in my office for all their help on this presentation and letting me practice about 1,000 times with it. Here's to a big comeback year for office in 2022. Thank you all for your time.
Thank you, John, for those insights, laughs, and predictions. I feel like it's only a good measure one more time, maybe COVID, for those who are a little thirsty in the audience.
There we go.
Next up, we have the industrial market. Please help me welcome Mitch Starczynski from NEWMARK.
All right, thanks for the intro, Liza. Hi everyone, my name is Mitchel Starczynski, and I'm a director with NEWMARK with a focus on industrial real estate. 2021, what an amazing year to be in industrial real estate. The industrial asset class has been the star that has shined the brightest. This is not only true for the Southeastern Wisconsin region, but also across the country. Nationwide, rental rates in the industrial asset class have risen on average by 12.4% year over year. From 2015 to 2019, average annual growth was only 5.8%. For as bright as the industrial asset class has been, there are still many challenges that we are working to overcome. Most of these challenges are related to the events of 2020. Because of this, I'm going to discuss 2020 as a reference point to help you better understand where we are today. Upon the onset of COVID-19, the economy shut down. many business owners were uncertain as to what their futures may hold. Their customers were putting orders and projects either on hold or canceling them altogether. Some employees were let go, and some had hours reduced. Unemployment reached a high of 14.7% in April of 2020. This is a number that we haven't seen since the Great Depression, which is when it exceeded 25%. By the way, that was in the year 1933, in case you were wondering. Materials were sometimes a challenge to come by. This included items like steel, which we use in the construction of industrial buildings, and aluminum, which many of us in the room use on a daily basis in the form of aluminum cans. This was from a combination of tariffs that President Trump had imposed a few years ago, and the shutdown of the economy and ports. This was an absolute disruption to the supply chain. All of these items contributed to the trickle-down effect that still affect today's economy and the industrial real estate. It's also prevented us from being even stronger. Fast forward to today, and our projects are moving full steam ahead. Unemployment is now at 4.2% as of November. We still have some room to achieve the 3.5% unemployment rate that we had in February of last year, pre-COVID. What's even more wild is that just 61.6% of working age adults work. Compare this to pre-COVID, which was at 64.8%, and that's an additional 6.55 million people that are no longer working. The price of an 8-foot 2x4 a year ago cost under $3.50, jumped to over $9 in April of 2021, and is now back below $5. For those of you in the room that had major house projects this past summer, I'm sorry. Lead time on some materials is still out 9 to 12 months on items such as steel and tilt-up concrete panels. If materials have not already been ordered for projects, we might not see them happen in 2022. These delays have also increased because of Amazon purchasing 30% of the nation's steel. I've also talked to a few contractors in the room, and pricing from 2018 to 2021 has increased by 15 to 20%, or 5% annually. This has been an additional constraint on the market. And as of November 15th, we still have container ships with an average wait time of 17 days, at which time 83 ships were either at anchor or in holding zone. Even with these obstacles that many employers are still working to overcome, we are seeing pent-up demand, which is why we currently show a vacancy rate of 5.2%, down from 6.6% a year ago. This was with an additional 4.6 million square feet of new construction. Given the low vacancy, which is propped up by a 9% vacancy rate in the central region, the theme for the market right now is to stay flexible and be ready. Tenants and buyers alike need to be ready when the opportunity arises. This means having minimum requirements, not ideal requirements, already being determined and financing ready to go. Tenants and buyers alike need to stay flexible when it comes to their ideal locations and/or square footages, which is why I mentioned earlier, minimum requirements and not ideal. An example of this in the West, where we currently show a vacancy rate of 2.8%, is the multiple groups that were competing for the last spec space available in both Muskego on Commerce Center Parkway and in New Berlin on Small Road. A deal to highlight in the West is ABB planning to build over 270,000 square feet on Lincoln Avenue west of Calhoun Road. This would be for office, research, and production space. They are also trying to bring in a logistics partner that would occupy an additional 309,000 square feet. Now onto the North region, where we currently have a vacancy rate of 4.2%. An example of staying flexible and being ready is Milwaukee Tool. They moved multiple growing business units, instead of just one, under the same roof when they leased the former Quad Graphics building in Menominee Falls. Investors, be ready. Rumors are that this will set a new cap record. The deal to highlight in the North is a building that was owned by Zilber and leased to Briggs & Stratton. This 700,000 square foot building sold to Exeter for $47.75 million, or $68 per square foot, and represented a roughly 5.2% cap rate. Now, for one of my favorite examples of staying flexible and being ready, comes from the central region where the vacancy rate is 9%. It comes from a landlord's perspective with Phoenix investors and their ability to stay flexible in order to land Amazon as a tenant. They removed roughly 425,000 square feet of building footprint, which does not include the second floor space, in order to create additional parking, better loading, and an enhanced image. A deal to highlight is Komatsu Mining and finally occupying the building down in the Harbor District. This would eventually free up their existing location for redevelopment. Now, I know I mentioned landlords being flexible, tenants and buyers being flexible, but even municipalities are becoming more flexible. In the South region, where the vacancy rate is 5%, there was a truck terminal on Pennsylvania Avenue that the municipality wanted to be redeveloped into a commercial use, going away from its current industrial use. Over time, they realized that the best fit for the site was industrial, and now there's a 125,000 square foot spec building being developed on that site. The deal to highlight in the South is the former Bucyrus campus, landing their first major tenant in Steel Solutions when they leased roughly 209,000 square feet. Now, there have been multiple instances of this, of staying flexible and being ready in Racine and Kenosha markets, which has a vacancy rate of 6%. This has been happening for years though, with the most recent trend being who can build it the quickest. There are currently over 15 buildings being constructed, totaling over 5.5 million square feet. A deal to highlight in the Racine and Kenosha market is HSA Commercial planning a large warehouse in Summers. They have filed plans to construct over 770,000 square feet of industrial space on the roughly 65 acres they are planning to purchase on Burlington Road. To sum it all up, it's a landlord's market. We have seen average rents rise from 2020 to 2021 with an increased difficulty to find space. I'm sure most of the brokers in the room can agree that we have done more deals in 2021, both for sale and lease, at or above asking prices. The theme for today, stay flexible and be ready. Now, on to Adam's predictions. And I want to thank Adam for providing me with this picture. If you haven't had the opportunity, please stop by and check out his newly sporting goatee. His first prediction, Amazon will continue to expand. Yes, but not at the rate that they have in recent years. In the last year, they grew by just over 700,000 square feet. Compare this to the 3.75 million square feet from a year ago, and it was just a slow year for them. Adam predicted investors will be very busy in 2021, but mostly from out of state. The cap rate compression and rising prices are slowing down velocity for Wisconsin-based investors. True. Investors are continuing to flock towards industrial as a preferred asset class. Many institutional portfolios have traded in the past for a sub 5.5% cap rate. However, we are now seeing some one-offs, Class A 350,000 square foot buildings trading below this now. Next, Adam stated manufacturers will continue to expand, outpacing current contractions due to market conditions. Not quite yet. I'd say we haven't seen as much growth as we might have thought. Many companies are still examining their operations before committing to reshoring efforts, which will then expand manufacturing operations throughout the country. Many are also still finding it a challenge to hire employees, which I mentioned prior. Next, Adam predicted that the Illinois to Wisconsin trend will continue to be strong. True, however, we have not seen the same velocity that we have in years past. Next, Adam predicted that the Central's vacancy rate will decrease. Adam needed to have an easy one here. True, this is primarily because of the JCPenney building leasing to Amazon. And last, Adam predicted that the Packers will go to the Super Bowl. Valiant effort, Adam, but we kicked a field goal instead of going for it on 4th and goal. Wrong. Now on to my predictions. Vacancy rate will be sub 4.5%. That means next year at this time, there will be less than 7 million square feet available. We will see another 3 million square feet come online in Racine and Kenosha counties in 2022. Given the land shortages that our core markets are experiencing, outlying communities will slowly, yes, slowly, start to see new construction. And I'm going to borrow one from John's book here. Aaron Rodgers will play for the Green Bay Packers next season. Thank you all for your time this afternoon, and go Pack Go!
Thank you, Mitch. All right, we're 2 for 2 on the Rogers prediction, so I'm wondering if our next speaker will make it 3 for 3. Next up is the retail market. Please help me welcome Joe Kleiman from Mid-America Real Estate of Wisconsin.
All right. Welcome, everyone. Thanks to CARW and NIOP for having me and giving me the opportunity to present my perspective on the retail real estate market in southeastern Wisconsin. I'd also like to thank my team at Mid-America for helping me put this together. I'm Joe Kleiman with Mid-America Real Estate. I have only a short amount of time, so I've had to be selective in the topics I will present, and fortunately for all of you, cut out all my really dumb jokes. So with that said, let's get to it. Today, I will cover the overall market statistics, break down the statistics by regional and community trade areas, discuss the trends in these retail trade areas, identify the demand generators, the challenges ahead, review Kelly Rodenkirk's 2020 predictions, and finally make my predictions for the upcoming year. But first, it's necessary that I define retail as it pertains to real estate, because in general terms, we think of real estate, we tend to think about real estate, retail as stores that sell products to consumers like clothing, appliances, sporting goods, and electronics. But when I talk about real estate, the definition is much broader. My definition of real estate not only includes traditional retail stores, but also hospitality, medical services, restaurants, auto services, fitness, financial institutions, and storage. So when I use the term retail, it's in reference to these broader definitions. So let's start by looking at some numbers. These statistics were provided to me, this first slide of statistics was provided to me from Catalyst Property Exchange database. This first slide is an overview of the overall retail real estate market in southeastern Wisconsin. As you can see, the vacancy rate is 1.6% lower in 2021 than it was in 2020, and the availability rate is lower by 1.3%. Surprised? I was, considering everything we've gone through in the past year and 3 quarters and are continuing to deal with today. So how do we avoid massive retail closures and vacancies? Mostly because there was a significant amount of cooperation between landlords, developers, retailers, as well as all levels of government. All of these stakeholders cooperated in a variety of different ways, and yes, I'll say the word unprecedented, in unprecedented ways. Some examples: landlords offered rent abatements, tenants offered additional lease term, developers delayed delivery of new product at rent commencement. The federal government offered PPP loans to keep businesses afloat and people employed and on the payrolls. States expanded unemployment benefits. Local municipalities eased codes and allowed for takeout alcohol and dedicated sidewalks and streets to outdoor dining. Without this cooperation, today's retail real estate market would be vastly different in a very ugly way. So at a macro level, the market appears to be strong. The next 2 slides are micro level snapshots. This first slide shows the stats of our regional trade areas. I included the Kenosha Highway 50 corridor as it's our most southern retail trade area that draws from a much larger geographical area. The vacancy rates here, taken from CoStar this time, do not reflect as optimistic a picture as the overall market. You might think this is a cause for concern, especially if you're the landlord sitting on vacant space. This next slide shows the statistics of select community trade areas. I picked these communities so we have statistics from across a geographical spectrum throughout southeastern Wisconsin. The statistics on this slide show a more encouraging picture. As you can see, very little vacancy or availability, with the notable exception of Midtown Center on Capitol Drive. Midtown has not been able to backfill or redevelop the former Walmart and has negatively affected the ability for that landlord to draw other users to the shopping center. To understand why the statistics on these slides diverge, we need to look behind the numbers. This is where the narrative is important. I think you see that the vacancy and availability rates in the regional trade areas, more specifically the malls, are not as dire as the numbers show. Take Brookfield, for example. Of the 427,000 square feet available in this trade area, half can be attributed to one vacancy, Boston Store. In addition, the former Boston Store Furniture Gallery, consisting of 55,000 square feet, is also still available. Same holds true for Southridge and Mayfair. Like Brookfield, over half of the vacancy in these trade areas can be attributed to one space. But retailers aren't shunning these trade areas. On the contrary, within these retail trade areas, more space has been developed to meet retailer demand. So while the retail footprint by the traditional definition at Brookfield Square is shrinking, retailers have opened stores at the corners of Brookfield. And contrary to national trends, that includes a 140,000 square foot Von Maur department store. The same holds true at Southridge, where 84 South was developed to meet retailer demand. In fact, two traditional retailers even backfilled part of the former Sears at the mall. And it's a similar story in Mayfair, in the Mayfair trade area, where Mayfair Collections and Meyer were developed also to meet the demand. This migration of demand from mall to shopping centers has been led by discount department stores and specialty retailers as they choose to locate, and in some cases relocate into these and other power centers. These centers are closer to the rooftops, more cost efficient than their mall counterparts, as common area costs are generally less and offer better convenience for consumers. And by the way, this isn't a recent development. The shift of traditional retail from the mall and department store to the power centers has been ongoing since the late 90s and early 2000s. So the following are some of the trends to consider. Malls are reducing their traditional retail footprint in favor of other uses. We're sitting in such an example right now. A conference center connected to a hotel, across from a medical facility, movie theater, Whirly Ball, Orange Theory Fitness, with new restaurants on the outlots and multifamily residential under construction right behind us. A second takeaway, mall properties are highly desirable as they're in prominent, high-profile locations. There will always be demand for these sites. 3, demand for space at shopping centers among retailers drove new development over the past several years. And the fourth takeaway, like the malls, many of these new retail developments have a mix of residential, hospitality, and/or medical components to them. Now, after going through all that, we've now touched on the hottest trend in retail real estate in southeastern Wisconsin today. The 1 to 2 acre sites in front of the malls, shopping centers, and other high traffic areas. These sites are highly visible, and they attract the most sought after users in retail real estate today. Generally speaking, these sites are developed as multi-tenant strip centers and single-use developments. The multi-tenant strip centers consist of diverse users such as food, medical, financial, salons and hair cutters, cell and cable service providers, fitness uses, and more. They're usually anchored by strong national brands that drive multiple weekly trips. The single-use developments consist of chain restaurants, banks, and auto uses. From existing brands to new chains looking to enter our market, these users are mostly quick service and fast casual restaurants, as well as casual dining chains. Also competing for these limited opportunities are car washes and other auto-related uses. The active players are generally the chains that are operated by corporate parent or well-heeled franchisees that can afford to pay the high acquisition costs and high rents that these sites command. You're familiar with many of these brands: Chipotle, Panera, Panda Express, Burger King, and Culver's, to name a few. There has also been a proliferation of chicken concepts, as Chick-fil-A, Popeyes, and Wingstop continue to expand, as well as new-to-market chicken chains, Raising Cane's, The Cluckery, Buffalo Go, and Dave's Hot Chicken. are entering the market and competing for sites as well as customer stocks. To be sure, some of the national chains have been closing as well. Several, but not all, the Perkins, Fridays, Hooters, and Applebee's have closed some of their existing restaurants. Since most are in very desirable locations, they will not be vacant for long as they're being backfilled or redeveloped by the users I just mentioned, as well as Louisiana seafood restaurants like Crab du Jour, Crab's a Million, and Crafty Crab. At this point, I've presented, I think, a pretty positive outlook for retail real estate in southeastern Wisconsin. But I'm not naive. There are challenges ahead. Malls, while ripe for redevelopment, still face obstacles like restrictive covenants, onerous operating agreements, and zoning constraints. Another challenge in today's market is the lack of new retail development. I showed this slide earlier, but here I added the column on the right showing square foot under construction. There's very little in the pipeline as we speak. This shortage of supply leads to the next challenge, an upward pressure on land costs and rents, which in turn will squeeze retailers' ROIs and ability to pay higher rents that developers will need to make their projects viable. Labor shortages, rising interest rates, rising construction costs, and inflation will also be challenging, just as it will be in other segments of retail real estate. And finally, the elephant in the room, and perhaps the biggest challenge of all, the pandemic. Feels like we're just getting back to our normal lives. But one of the lessons of the pandemic is that one event can change the trajectory of a strong economy instantaneously. Something I don't think any of us have experienced before. So all that said, the retail real estate market in southeastern Wisconsin is strong and healthy, but there's reason to be cautious. And now it's time to review Kelly's predictions from last year. Kelly said vacancy rates will continue to increase. Fortunately, and I think Kelly would be happy about this as well, that didn't happen. They decreased by 1.6% overall. Local restaurants will continue to close, but some will come back stronger than ever. Yes, several restaurants did close and some reopened, but it's difficult for me to assess whether or not they're stronger. And her third prediction, 2021 will bring the end of the virtual happy hour. Saw everybody out having drinks before, we'll probably see everyone out after as well, so that's a good one. And now for my predictions. We will see new chain restaurants enter the market. Number two, this holiday season, brick and mortar retail will see an increase in foot traffic over pre-pandemic levels as consumers want to get off the couch and back into social settings. And three, similar to Warby Parker and Untuckit, we'll see at least one new retailer that originated online with e-commerce open brick and mortar locations. I'd like to thank you for your time and attention, and I'll give the podium back to Liza.
Thank you, Joe. And now, last but certainly not least, we'll touch on the investment market. Please help me welcome Jennifer Huber-Bullock with Colliers International in Wisconsin. All right, thank you, Liza. Good afternoon. My name is Jen Huber-Bullock. I'm a senior investment analyst on the Colliers Investment Services team here in Milwaukee. I'm excited to be able to present this update during such a historical year. The theme for 2021 is without a doubt record-breaking. From inflation and GDP growth to pricing and cap rates, records were broken all year long. Even today's weather, mid-60s in December in Wisconsin with a threat of tornadoes on the western side of the state is breaking records. Side note, my dream job growing up was a tornado chaser, so by all this presentation, I'm heading out to chase my dream. Today I'll cover a brief overview of the economy, trends and top transactions from 2021, and a few 2022 predictions. We could spend hours and hours discussing the economy and happenings of this year, but Tracy gave me 10 minutes, so let's get started. 2021 started out with a glimmer of hope for the economy with the mass distribution of the COVID-19 vaccines.
More companies welcome employees back into their offices, restaurants and bars reopened, and events like this one, sporting events, and concerts switched back to in-person formats. Even the Olympics made a return in 2021, and best of all, it happened just in time for this little piece of Milwaukee history. This is the only sports reference I have today, sorry guys. The short-lived recession in 2020, which lasted 2 months to be exact, the shortest in history, has resulted in extraordinary growth in our economy. Unemployment hit 4.2%, down from the pandemic high of 14.8% in April of 2020, with unemployed persons down from its high of 23.1 million to just 6.9 million today. GDP growth is estimated to end the year at around 5.5% and drop slightly in 2022 to near 4%, both still well above the historical average. Inflation surged in November to 6.8% year over year, which is the fastest pace in 40 years. Removing the volatile energy and food prices, the core index is still up 4.9% year over year, a 30-year record. Supply chain disruptions are a leading cause of this increase. With inflation skyrocketing, the Federal Reserve just announced hours ago that it will cut back on its purchases of Treasury and securities, which will allow for a federal funds rate hike in 2022. 3 rate hikes are anticipated of approximately 25 basis points each, starting in March. Now let's run through some of the trends from this year. After a decline in 2020, sales volume returned to near pre-pandemic levels in 2021. Through the third quarter alone, Metro Milwaukee area has already exceeded $1.69 billion in sales volume. To compare, 2019 stood at $1.84 billion. It's safe to say that we will exceed this number by year end, as there continues to be extreme demand driving asset pricing to levels we have not seen before. All that pent-up dry powder that sat on the sidelines during the uncertainties of 2020 faced a big hurdle in 2021. Too much money chasing too few deals. This created unprecedented competitive bidding environments for core and even Class B deals, particularly in the industrial sector, and drove product pricing through the roof and compressed cap rates. Pricing is up nearly 20% year over year for industrial product, with multifamily up 17%. Retail pricing is up 14%, which is the highest rate since the Great Recession. When it comes to cap rates, I pulled up Tom Shepard's market presentation from 5 years ago in 2016. At that time, average cap rates across all sectors, excluding multifamily, ranged from the low to mid 7% ranges. Multifamily then was at 6.5%. In today's market, those cap rates have compressed significantly. Industrial and multifamily product have started to trade in the mid to upper 4% cap rate ranges. Net lease product, including retail and office, have traded as low as 5.5 caps, with multi-tenant trading in the mid 6s to low 7s. So who's buying right now? In the Milwaukee market, private equity has placed 72% of the capital year to date, the highest share in over a decade. On the other hand, REITs hit their lowest share of acquisitions in our market since 2011, with just 2.2%, as they continue to target the Sun Belt and coastal states, which had strong market fundamentals such as population growth during these uncertain times. Let's take a look at a few key sales from 2020, starting with office. Office investment sales were limited this year to mainly single-tenant net lease assets. Aurora, DentaQuest, Manpower, and Rexnord all saw sales of their respective office buildings they occupy. Most notably, the extensively renovated Rexnord office building in downtown Milwaukee sold to SunTrust Bank for a record-setting 5.5% cap rate with a 15-year in place, 14 years remaining. The Manpower headquarters downtown also sold for a second time in 4 years and nearly $70.5 million at an estimated 6.5% cap rate. The most notable multi-tenant office sale occurred just weeks ago with Group RMC's acquisition of Chase Tower. This marks Group RMC's third major office acquisition in the Milwaukee market in just as many years. The private equity group out of New York previously bought 330 Kilbourne and the 12-building Brookfield Lakes office portfolio. In total, Group RMC now owns 1.5 million square feet of mainly office product in Metro Milwaukee. On the retail side of things, demand was largely dominated by net leased assets, particularly grocery-anchored centers and retailers deemed essential that remained open through the pandemic. This paved the way for additional cap rate compression of single-tenant assets. The Whole Foods sale on the east side is a perfect case study of the pandemic's effect on pricing and cap rates. Adam Connor put this deal under contract literally 1 week before the nationwide shutdowns in March 2020. About a month later, that buyer, Exchange Realty out of California, terminated the deal with the pandemic beginning to rage. Less than a year later, that same buyer approached Adam with renewed interest in this asset, and it sold in early 2021 for $1 million more than what they had it under contract at the previous year, with no changes other than 1 less year of lease term remaining. This set a record cap rate at 5.5%, demonstrating the strong demand and the lack of product on the market. Grocery-anchored multi-tenant centers have also seen aggressive pricing, like the Marketplace at Pabst Farms, which traded for a 7.25 cap as one example. There's no shortage of multifamily sales in 2021 to talk about, with additional cap rate compression like others in this category. Newer Class A product traded as low as the mid to upper 4% cap rate range, with prices as high as $290,000 per unit. A couple notable sales are highlighted on the screen, including Vin Vigor in the Brewery District. This new 2-building development, located just blocks from Pfizer Forum, traded at a sub 5% cap rate, with the retail component still being vacant. And now for the winner of 2021, industrial. No surprise to anyone in this room. Like multifamily, there were numerous to choose from, so I highlighted a couple that really stood out this year. The Racine County 2-building portfolio featuring Goodwill and Local Glass, each occupying 1 building, traded for under a 5% cap rate and with just 4.5 years of weighted average term remaining. North in Germantown, Zilver sold their single-tenant Briggs & Stratton deal to Exeter for a strong 5.3% cap rate. And although I didn't cover the Madison market today, I'd be remiss not to highlight the UW Health building that sold for a staggering 4.5% cap rate. UW uses this building for warehousing and distribution of medical supplies, which is undoubtedly a strong industry in today's world. But we're not finished with industrial yet this year. Our team is closing, knock on wood, a core quality institutional asset with a cap rate that will reset the industrial market to unthinkable levels. This has absolutely nothing to do with the deal that Mitch mentioned. Mitch. While I can't disclose all the details, I can tell you this deal is not located within the hot I-94 Kenosha-Racine County corridor. Please watch press releases later this week and early next week for a sale announcement of that deal. This closing will source fresh East Coast capital to our state. With pricing in the Chicago, Indianapolis, and Cincinnati distribution triangle trending towards sub 4% cap rates, I believe we will see additional new entrants to our market in 2022 and beyond. With that, let's move on to predictions. Here's a look at Gretchen Richards' predictions from 2020. Gretchen said there will be an increase in adaptive reuse of existing assets. This one's debatable, however, I put false for the Milwaukee market. While this could potentially be true for Madison, where Gretchen is based, this year in Milwaukee, I would say in general, we've had less adaptive reuse than in past years and more ground-up construction starts. Further cap rate compression for industrial and multifamily, absolutely true without adults. This is an excellent prediction that came true. Gretchen also said that 2021 will surpass 2020 transaction volume. Again, most definitely will end up being true by year end if it hasn't already surpassed that. Net lease demand will continue to rise. Again, this is a true prediction. Going back to the Whole Foods story is a prime example. And last but not least, increase in portfolio sales across all sectors. I would say this one's debatable. I said this is false, as I did not see as many portfolio sale transactions across all sectors, although some did experience more sales of portfolios. As for my 2022 predictions, I predict that industrial and multifamily will dominate transaction volume. There's no signs of slowing down for these asset types. A 2022 investor outlook survey conducted by Colliers showed that 67% of investors plan to chase industrial deals next year, and 53% will target multifamily. Land could be another product type that's in play for 2022. Continued trades at record low cap rates set in 2021, but will not compress further amongst most sectors. With product beginning to trade more frequently in the mid 4% ranges, I don't believe we'll see much more compression beyond that. However, there is room for compression with multi-tenant office cap rates, which we could see next year. And my final prediction is the number of multi-tenant, the third prediction, 2022 transaction volume will exceed 2021. I think these historically strong macro and market fundamentals will outweigh any other concerns the market may have, including any increases to the federal funds rate. 2022 should be another exciting year for investment real estate. And the final one is the number of multi-tenant and office sales will increase for 2022. This one is heavily based on where we are with COVID. We saw the emergence of the Delta variant shift office reopenings of fall of 2021 to 2022. Continued major sustained increases in infections nationwide or new variants, excluding the Omicron, which is not seen as a substantial threat, could push recovery out of these two sectors. That's it for a high-level overview of the 2021 investment markets. I hope you all have a wonderful and enjoyable holiday season. Be safe and healthy.
Thank you, Jennifer. And again, thank you to all 4 of our presenters. Please give them one more round of applause. And thank you to all of you who are attending in person the 18th annual NAP and CAR-W Market Update, presented by First American Bank. Just a quick reminder, please take the placemats at your table if you'd like. The placemats and the presentations will all be emailed to you electronically following the event. We also want to say a special thank you to all of our sponsors. Also a quick shout out to many amazing companies that serve as annual sponsors to both organizations, so thank you so much for your support. Finally, I want to recognize members of the association staff, Amanda Hoffman, Tracy Johnson, Fran McLaughlin, Alexis Strode, and Jim Villa. Our associations are very fortunate to have such exceptional staff that work tirelessly on this event and all events throughout the years. Also a big thank you to the Brookfield Conference Center and Magic Productions for all of your assistance to make this event go smoothly tonight, so thank you again. And now, you're all invited to join us to celebrate the successes in the market that we've heard from our 4 presenters today and sharing some of that holiday cheer. The networking reception sponsored by Reinhardt Berner Van Duren, attorneys at law, starts now and goes until 7. Thank you, and I hope you all have a great evening.